Do you want to get the most out of the market? Find zones where price will very likely change direction. Zones that will protect your stop loss and give you good profit? In this video, I'll show you the most accurate method for finding supply and demand zones based on removed liquidity. We'll look at a trading strategy with a very high win rate, over 70%. We'll peek into zones where big money was building their position and which they'll defend at any cost. Most traders lose in the market exactly where big money is just building their position. These aren't random movements, but a well-planned strategy of smart money. And today, I'll reveal this mechanism to you, which will help you move from the victim category to the winner category. To understand the logic of our entries, let's first clarify what a liquidity sweep is and why it happens. We already covered liquidity sweeps in a previous video, which you can find on the channel, but let's review since it's also necessary for this strategy. A liquidity sweep is a maneuver where price sharply breaks through an important technical level, support or resistance, triggers the stop losses clustered there, and then quickly returns back. On the chart, this often appears as a long candle shadow or a candle that crosses the level followed by another candle that returns back beyond the level. But why does this happen? The answer is simple. The market is controlled by big players, and they need to build a position of sufficient size before moving price in their desired direction. If an institutional trader simply places a huge buy order, the price would shoot up sharply before they could get the volume they need. Instead, big players use a trick. They push the price toward areas where retail traders' stop losses are concentrated. When these stop losses are triggered, often as market orders, this creates a flow of liquidity that big players use to build their positions. Essentially, they're hunting for your stop losses to get the liquidity they need. So now we understand that a liquidity sweep serves as a position-building area for big money, which means if price returns to the range where big money was building its position, big money will defend this zone and not allow the price to fall below it. We already know from the previous video that price moves from liquidity to liquidity. If big money has already collected liquidity in one place, then there's no reason for price to go lower. Therefore, zones where a liquidity sweep has occurred become powerful demand and supply levels. When price returns to these zones, we can expect a strong market reaction, since big money will defend its positions. So in this trading strategy, we'll be looking for zones that have made a liquidity sweep. These zones are the strongest zones on the chart. It's important to understand that not all liquidity sweeps are equally valuable. The strongest zones form after aggressive sweeps, when price deeply penetrates beyond a level and quickly returns. This signals active participation of big money. It's also worth paying attention to trading volumes during the sweep. If the sweep is accompanied by high volumes, this confirms that big money really used this opportunity to build a position. The higher the volume, the stronger the zone. This works in both directions, for both long and short positions. Let's move on to the trading system based on this market mechanism. In the previous video, we looked at a strategy of entering right after a liquidity sweep. This time, our strategy will be slightly different. We'll still wait for a liquidity sweep, but this time the candle that made the liquidity sweep will be considered our zone of interest, where big money will likely reverse the price if price reaches it. So we need to determine the trend. You can learn how to do this from the two previous videos. Mark the levels. Wait until price makes a sweep, or find already formed structures that have made a sweep. Mark the zone on the candle that made the sweep, and wait for price to return to this zone. With high probability, price will bounce off the zone that made the sweep. Here's how it looks. We see a price chart. The trend is upward because each previous low breaks a new high, which means we're looking for an entry into a long position. We find places where price made a liquidity sweep. We mark them as resistance or supply zones. We set targets where price hasn't yet collected liquidity. We wait for price to come to our demand zone. We place a buy order, set the stop loss beyond the zone, and set the take profit at a place where liquidity hasn't yet been collected. That's all there is to it. Let's look at an example. We see that each high was broken by a new high, which means we're in an uptrend, so we're looking for a long position. We find a liquidity sweep. We mark the candle that made the liquidity sweep as a support zone. We mark our targets, where price is most likely to go after bouncing off the zone. We wait for price to approach the zone, Then we place a long position and set a stop loss below the sweep, and set take profit at our target. The trade was executed successfully. Another example. Looking at the chart, we can see higher highs forming consistently, confirming we're in a bullish trend, so we want to enter a long position. We identify where price swept through liquidity. We mark the candle that created this liquidity sweep as our key support area. Then we identify our profit targets, the likely levels where price will move after bouncing from our support zone. We patiently wait for price to approach this support zone, then enter our long position. We protect ourselves by placing a stop loss just below the liquidity sweep and set our take profit at our predetermined target level. The trade plays out as expected and hits our take profit, resulting in a successful trade. Next example. We see that the market here is also uptrending. There was a trend line and price broke through it, collecting liquidity from the entire trend line. We find a liquidity sweep and mark the candle that made the sweep as our zone of interest. We mark targets where price is most likely to stop. We see that there was also a liquidity sweep on the opposite side, which means there's a high probability that price won't go above this sweep, so we mark this sweep as our target. Now we place a long position, set the stop loss below the lower sweep, and set take profit at the opposite zone. We see that price was stopped by the opposite zone. Another example. Looking at the chart, we can see higher highs forming consistently, which tells us we're in an uptrend, so we look for a long entry. We find where price swept through liquidity and mark this candle as our support area. We set our profit targets where price will probably go after bouncing off support. We wait patiently for price to reach our support zone, then place our long position with a stop loss just below the sweep and take profit at our predetermined target. The trade works out perfectly. Another example. We see that each high has been broken by a new high, confirming we're in an uptrend, so we search for a long position. We identify a liquidity sweep and mark the candle that created this sweep as our support zone. We determine our targets, where price will likely move after bouncing from the zone. We wait for price to approach the support zone, then enter our long position and set a stop loss behind the sweep, with take profit placed at our target. The trade completes successfully as planned. Another example. We can see that price is moving sideways with no clear higher highs or lower lows, indicating we're in a ranging market. We identify a liquidity sweep at the range boundary and mark the candle that made this sweep as our support zone. We determine our targets, where price will likely move after bouncing from this zone. We wait for price to approach our support zone, then enter our long position and place a stop loss behind the sweep. The trade executes successfully as price bounces off support and moves toward our target. This strategy works for short positions as well. Another example. We can see that each low was broken by a new lower low, which means we're in a downtrend, so we're looking for a short position. We find a liquidity sweep at the top. We mark the candle that made the liquidity sweep as a resistance zone. We mark our targets, where the price is most likely to go after it drops from the zone. We wait for the approach to the resistance zone. Then we place our short position and set a stop loss above the sweep, with the take profit set at our target. The trade was executed successfully as price moved down to our target level. Let's look at factors that strengthen our trading strategy. As we already know, price moves from liquidity to liquidity. We enter where liquidity has already been taken, meaning in the zone that made a liquidity sweep. But a strong magnet for price will be breakouts of trend lines, since a trend line consists of many peaks, each of which is a pool of liquidity. So, to strengthen our strategy, we need to look for entry from zones that have made a sweep and set take profit at the breakthrough of trend lines, which means collecting liquidity from all the peaks of the trend line. We see that the market is in a sideways pattern, which means we can look for both long and short positions. We find a liquidity sweep and mark the candle that made the sweep as our zone of interest. We identify targets. In this case, we see a strong upward trend line. Price will very likely collect liquidity from the entire trend line. We place a long position and set the stop loss below the sweep. We set the take profit at the last peak of the trend line. The trade is successful, as price collects liquidity from the entire trend line. Another example. Here we also observe the market in a sideways range, which tells us we can hunt for either long or short positions. We identify a liquidity sweep and mark the candle that created this sweep as our zone of interest. Looking at potential targets, we notice a strong upward trend line. There's a high probability that price will collect liquidity from the entire trend line. We enter a long position and place our stop loss beyond the sweep. Our take profit is set at the final peak of the trend line. The trade plays out successfully, with price collecting liquidity from the entire trend line. But wait, in this trade we could have entered differently. We notice another liquidity sweep. Mark the candle that created this sweep as our zone, and prepare to enter a position. Another example. Here we'll be looking for a short position. We see there was a strong upward movement. A short trend line has formed below, so price will likely go down to break it. We find a liquidity sweep and mark the candle that made this sweep as our zone of interest. We place our position with take profit before the zone, stop loss above the zone, and take profit at the breakthrough of the trend line. The trade is successfully executed. So we've examined a powerful trading strategy based on liquidity sweep zones. When price sweeps a level, smart money uses this moment to build their position. These zones become critical price reversal points with a high win rate of over 70%. Let's summarize our strategy. 1. Determine the market trend. 2. Find liquidity sweeps on the chart. 3. Mark the candles that made the sweep as zones of interest. 4. Wait for price to return to this zone. 5. Open a position with a clear stop loss beyond the sweep zone. 6. Set take profit at levels where price hasn't yet collected liquidity. Best results come from combining entries from liquidity sweep zones with exits at trendline breakouts, where a lot of liquidity is concentrated. This strategy will help you transition from being a market victim to becoming a winner who understands how smart money operates. If this video was helpful, don't forget to like and subscribe to the channel so you don't miss upcoming videos about profitable trading strategies. Thanks for watching.